Now, the streets of Hong Kong, once a beacon of civilization, are bereft of these iconic signboards. The vibrant nightscapes of old can now only be seen in movies. The bare streets of today mark the end of an era of prosperity, becoming a thing of the past. Is this a move towards civilization? Without these signboards, it feels as if the city has lost its soul, and the once vibrant Hong Kong is no more.
The end of an era in Hong Kong. Continued decline in import and export trade. Data released by the Hong Kong government's statistics department shows that in September, the total export value of goods was 380.3 billion Hong Kong dollars, 48.8 billion US dollars. This represents a year-on-year decrease of 5.3%, falling short of expectations and marking a 17-month consecutive decline, the longest since records began in 1952. The value of imports was 440 billion Hong Kong dollars, a decrease of 0.4% year-on-year. Last month's tangible trade deficit was 64.6 billion Hong Kong dollars, 14.5% of the total value of goods imported. Comparing the first 9 months of 2023 with the same period in 2022, Hong Kong's total export and import volumes of goods decreased by 15.6% and 12.9% respectively. In August 2020, the United States government announced a new regulation. All goods from Hong Kong must be labeled as made in China and cannot bear the Made in Hong Kong label. This effectively ended Hong Kong's preferential trade status with the US. Since the CCP took control of Hong Kong, especially under Xi Jinping's leadership, Hong Kong's international trade status has been continually weakening. Exodus of foreign institutions. According to the Wall Street Journal in October of this year, citing statistical data, the number of American companies in Hong Kong has been declining for 4 consecutive years. As of June 2022, the number had dropped to 1,258, the lowest since 2004. In contrast, last year, the number of Chinese companies with regional headquarters in Hong Kong surpassed American companies for the first time in at least 30 years. Rapid flight of international capital. The poor economic performance of Communist China has alarmed investors in Hong Kong. So far this year, the Hong Kong stock market has fallen by more than 11%, making it the 4th worst performing stock market globally. The capital raised by new stock listings is only 2.7 billion US dollars, the lowest in 20 years. According to Deloitte, in the first 3 quarters of this year, Hong Kong's global fundraising market ranked only 8th behind mainland China, the USA, UAE, India, and Indonesia. Excluding mega IPOs over $1 billion, the average fundraising amount for new stocks in Hong Kong dropped from last year's $750 million to $590 million this year, the lowest in the past decade. Dealogic data shows that last year's IPOs in Hong Kong totaled 13.4 billion US dollars, a roughly 70% decrease from 2021, with this year's transactions being even lower. In October, a survey by the Private Wealth Management Association and KPMG China reported that in 2022, assets managed by private banks and wealth management institutions in Hong Kong dropped by about 15% from the previous year, with net inflows of funds decreasing by about 80%. Meanwhile, an increasing number of large Chinese enterprises are opting to list in Hong Kong. As of September 30th, 2023, companies from mainland China accounted for over $4 trillion of the market value on the exchange, while other companies' combined market value was less than $1 trillion. On this matter, Liu Mengxiong, a senior finance professional in Hong Kong and former member of the Chinese People's Political Consultative Conference, expressed that the proportion of mainland Chinese enterprises in the Hong Kong stock market is increasing, while the withdrawal of foreign capital is intensifying. He believes this significantly impacts Hong Kong's status as an international financial center. With the total value of the Hong Kong stock market at approximately 35 trillion Hong Kong dollars, close to 4.5 trillion US dollars, the daily trading volume of only 80 billion Hong Kong dollars, about 10 billion US dollars, is disproportionately low. Among the more than 2,000 listed companies, nearly half have 0 transactions, and over 100 are suspended. He opines that this reflects a hemorrhaging of Hong Kong as an international financial center, a status now overtaken by Singapore as the world's 3rd largest financial hub.
The Hong Kong International Financial Center is bleeding out. Even in IPOs, the amount raised is now lower than that in Indonesia, a situation previously unimaginable. The primary issue, he suggests, lies in the recent policies raising doubts about Hong Kong's future under Beijing's governance system. Questions arise whether the policies enacted by the Hong Kong Special Administrative Region are leading towards a one country, one system framework, assimilating Hong Kong into mainland China and transforming it into an ordinary mainland city. Despite Beijing's verbal commitment to one country, two systems, actions taken suggest a move towards one country, one system.
Furthermore, the U.S. Federal Retirement Thrift Investment Board, FRTIB, with assets totaling $771 billion announced on November 14th that it would adjust the benchmark index of its international fund, excluding exposure to Hong Kong. The statement cited investment restrictions in sensitive sectors in China, delisting of Chinese companies from U.S. exchanges, and sanctions on Russian securities as causes for transaction cost and return volatility. This indicates an impending further depletion of funds in the Hong Kong market. Real estate prices plummet. As early as August this year, Cheongkong Holdings, owned by Li Ka-shing, launched a new development called Qinghai Yi 2 in Yaotong, Kowloon, one subway stop from Hong Kong Island. The pre-sale properties, expected to be completed in October 2025, had their first price list published. The most affordable unit, with a practical area of 210 square feet, approximately 19.5 square meters, was offered at a discounted price of 2.9 million Hong Kong dollars, 13,810 Hong Kong dollars per square foot, 30% cheaper than surrounding second-hand properties. This is nearly equivalent to prices from 7 years ago. Bloomberg's latest news reports that an office building in a prime location owned by Goldman Sachs has had its asking price slashed from 1.3 billion Hong Kong dollars to 900 million Hong Kong dollars, a reduction of one-third, and is still unsold. The 25-story 88WL office building, conveniently located near the Shengwan MTR station, features restaurants on the lower floors and balconies with ocean or mountain views on the upper floors. American investment bank Goldman Sachs holds a majority stake in this building, with Shanghai-based private real estate fund Lai Kong-Rui Group, also an investor, currently urgently seeking to sell the entire building. Taiwanese financial expert Xie Chenyan comments,
The number of vacant properties for sale in Hong Kong is staggering. In the third quarter of this year, there were 20,483 private residential properties on the market, exceeding 20,000 units. Who used to scramble for Hong Kong's real estate, and why did prices only ever rise? Firstly, all construction projects were controlled by the four big families, monopolizing the supply of real estate. Secondly, the interest rates were very low, making the cost of purchasing property minimal. Who were the buyers? Mainland Chinese buyers were incessant, as compared to cities like Shenzhen, Beijing, and Shanghai. Hong Kong's real estate seemed inexpensive. But now, with the collapse of the real estate market in mainland China, who would buy property in Hong Kong? No one. So what happens when even the four big families start to sell off their real estate holdings? How does that affect the individual investor's perception of the future housing market? Look at the foreclosed properties. Even with a 20% discount by banks, they still can't be sold.
Simply put, Hong Kong residents themselves actually lack the capacity to absorb the real estate market, with most of the capability resting with international investment banks and financial institutions. Previously, over 30% of Hong Kong's real estate depended on these large institutions, but they are now increasingly moving to Singapore. Currently, the rent for Grade A office spaces in Hong Kong has dropped by 30%, yet they remain unleased, with a vacancy rate exceeding 15%. In comparison, Singapore's commercial real estate vacancy rate is less than 5%. Most foreign institutions, especially in the finance sector, have been bearish on Hong Kong's property market in recent years, with nearly all foreign enterprises exiting, particularly as financial professionals in Hong Kong command high salaries and can afford such steep rents. Once they started leaving, Hong Kong's property prices began to tumble. Coupled with a significantly weakened overall economic support, high bank loan interest rates, and the subsiding wave of mainland Chinese buying properties in Hong Kong, the fundamental support for the Hong Kong property market is nearly non-existent.
Currently, prices are expected to continue declining, with Morgan Stanley predicting an average price drop of 5% to 18%. However, as early as 2022, Goldman Sachs reported that Hong Kong's real estate market would plummet by about 20% in the coming years. This forecast by Goldman Sachs not only proved accurate, but the decline is even more significant than anticipated. Thus, reflecting China's economic slowdown, Hong Kong's property market is also becoming increasingly pessimistic.
Hong Kong government faces record-high fiscal deficit. Efforts to attract foreign investment yield little success. Statistics published by the Hong Kong government in September show that for the first 5 months of the fiscal year 2023, the deficit was nearly 136.2 billion Hong Kong dollars, about 17.5 billion US dollars. By the end of August, fiscal reserves had decreased to 698 billion Hong Kong dollars, about 89.6 billion US dollars, a reduction of approximately 39.1 billion Hong Kong dollars, or 5 billion US dollars, from the end of July. Excluding the revenue from the issuance of green bonds, the fiscal deficit deficit exceeds 182.8 billion Hong Kong dollars, over 23.4 billion US dollars. In the latest policy address, the Hong Kong government proposed reducing the stock stamp duty and adjusting property market cooling measures, but to no avail, while still having to cater to new measures proposed in the policy address. Including this year, Hong Kong has seen a fiscal deficit in 4 of the last 6 years, with this year marking the third time the deficit has exceeded 100 billion Hong Kong dollars. On this matter, Norman Chan, chairman of Fubon Group and Hong Kong's former Secretary for Financial Services and the Treasury, stated in a media interview,
"The current state of Hong Kong's economy is the worst in nearly 20 years. The overall economy is weak and all industries are facing difficulties. Both the stock and property markets are declining, making everyone poorer than before, hence reducing consumer spending power. Hong Kong is currently besieged on all sides, with geopolitical relations reducing foreign capital inflow. Moreover, with many issues in mainland China, Hong Kong can no longer rely on China as it did in the past. The shrinking fiscal reserves, coupled with the fiscal deficit, are placing public financial pressure on the Hong Kong government."
In an attempt to attract foreign investment, the Hong Kong government has indeed taken some measures, including hosting the second Global Financial Leaders Investment Summit and reopening investment immigration, which requires 30 million Hong Kong dollars investment for entry, but these efforts seem to have little effect. The second Global Financial Leaders Investment Summit was held in Hong Kong on November 7th, attended by over 300 high-level executives from global financial institutions, including James Gorman, Chairman and CEO of Morgan Stanley, David Solomon, CEO of Goldman Sachs, Colm Kelleher, Chairman of UBS Group, and Christian Sewing, CEO of Deutsche Bank. The next financial crisis emerged as a key topic at the summit, with investment banks unanimously mentioning political factors associated with it. Deutsche Bank CEO Christian Sewing expressed, "The greatest fear is that a geopolitical crisis could escalate, possibly quickly, unsettling the markets and triggering a crisis. The financial world must remain highly alert to risks and conduct stress tests." Morgan Stanley Chairman James Gorman added,
"The financial crisis could be linked to political or geopolitical factors. It's evident that democracy is being challenged in certain countries."
Alicia Garcia Herrero, chief economist for Asia-Pacific at Natixis, stated, "Hong Kong is no longer a global financial center, and I believe it never will be again. It will become an offshore center for the mainland, which might create jobs, but probably not the same kind of jobs as before." Regarding new investment immigration, according to previous statistics from the Hong Kong Immigration Department, approximately 35,000 investment immigration applications were approved between 2003 and 2015, with about 90% of applicants being Chinese nationals with foreign permanent resident status. This indicates that the primary participants in Hong Kong's so-called investment immigration have been from mainland China, serving as another channel or stepping stone for wealthy mainlanders rather than attracting foreign investment. In the current situation, the attractiveness of Hong Kong's investment immigration status to wealthy individuals from the mainland is likely to diminish significantly. High property prices in Hong Kong, low happiness among residents. According to the United Nations 2023 World Happiness Report, Hong Kong's happiness index ranking fell 1 place to 82nd, significantly behind its major competitor, Singapore, 25th, and also lower than neighboring mainland China, 64th, and Taiwan, 27th. It even ranks below Thailand, 60th, Vietnam, 65th, and the Philippines, 76th. The Happiness Index assesses 9 areas: education, health, environment, governance, time, cultural diversity and inclusivity, community vitality, inner well-being, and standard of living. In fact, since 2012, Hong Kong's Happiness Index consistently ranked lowest among the 4 Asian tigers: Taiwan, South Korea, Hong Kong, and Singapore. In recent years, it fell even below mainland China, with high property prices being a major contributing factor.
We're now filming property prices in Hong Kong, currently in Wan Chai, on Hong Kong Island, where prices are relatively higher. Let's look at this 1,500 square foot apartment priced at 58 million Hong Kong dollars. A very ordinary property, but 58 million Hong Kong dollars is expensive. This price seems excessive.
What are you laughing at?
It's just so expensive.
So expensive it leaves you speechless.
I'm so poor. This apartment, 1,485 square feet, is priced at 60 million Hong Kong dollars, including a terrace and parking space.
Parking spaces are also expensive, costing millions on their own.
I really doubt my life. I never thought it would be this expensive.
When I first came to Hong Kong, I felt just like you. Now I've become numb to these numbers. They seem unrelated to me.
I know it's expensive, but this is unreasonably expensive. And this isn't even the most expensive area.
Comparing data, we find that Singapore's purchasing power index is almost 50% higher than Hong Kong's, and the property price to income ratio is only a third of Hong Kong's. In terms of the overall quality of life index, Hong Kong scores 105, while Singapore scores 158, indicating that the quality of life in Singapore is 50% higher than in Hong Kong. This conclusion comes from comparing data on major consumer categories in both places. The end of Hong Kong. Hong Kong's current plight can be attributed to the CCP's transition from covert to overt intervention and the Hong Kong government's compliance and complicity. The former Asian tigers, now developed economies, have been taking measures to escape the middle income trap and achieve industrial upgrading and economic growth goals. South Korea has Samsung, Taiwan has TSMC, and Singapore has transformed into a new financial center in Asia. What effective measures does Hong Kong have to showcase? None. This isn't to say that the others are without issues, like South Korea's pervasive chaebol conglomerates, Taiwan's political strife, and Singapore's authoritarian governance and environmental factors, but as members of the international community, they at least retain mechanisms and opportunities to improve and correct errors. However, after 1997, Hong Kong, overly reliant on the mainland market and land finance, has lost opportunities for industrial upgrading and self-improvement. With the implementation of the Hong Kong National Security Law and Anti-Espionage Law, among other draconian laws, Hong Kong's already eroding living environment has become increasingly unbearable. According to the latest data from the International Monetary Fund, IMF, the so-called four Asian tigers had the following per capita GDP in 2021. Singapore at $66,263, Hong Kong at $49,485, Taiwan at $33,402, and South Korea at $35,196. Hong Kong, once the Pearl of the Orient and backed by China, has been gradually falling behind. In the 1990s, Hong Kong and Singapore were on par, but since 2003, when Singapore's per capita GDP surpassed Hong Kong, it has left Hong Kong trailing. It is often said that capital has the keenest sense of smell. As international capital rapidly and massively flees, Hong Kong's status as an international financial center is diminishing, and its ability to attract foreign investment is increasingly being eroded. However, due to the needs of CCP elites and the vast bureaucratic system, Hong Kong's function as an outlet for domestic capital flight will likely be retained for a considerable period. A recent example is the influx of mainland residents into Hong Kong to open bank accounts around National Day. Noel Quinn, CEO of HSBC Group, stated at the second Global Financial Leaders Investment Summit held by the Hong Kong government on November 7th that the wealth flowing from mainland China to Hong Kong this year has increased by at least 3 to 4 times. There have always been channels for capital to leave mainland China through Hong Kong. As early as 2016, Guangdong Province, neighboring Hong Kong, cracked down on 194 underground banking cases. According to data released by the Guangdong Provincial Public Security Department, the amount involved reached 250 billion yuan, accounting for 1.2% of the country's foreign exchange reserves at that time. Lin Jiang, a professor of economics at Sun Yat-sen University, commented,
"In the last 1 or 2 years, private capital outflow exceeded $100 billion annually, not counting those that skirt legality under the guise of legitimate institutions, which are unaccounted for."
He noted that most underground banks rely on the Guangdong-Hong Kong corridor for capital outflow, and despite strict crackdowns in the mainland, they keep resurfacing. Striking to the end is just a drop in the ocean unless Hong Kong businesses are all shut down. However, as the economic situation in mainland China continues to worsen, the cost and risk of capital flight through Hong Kong are increasing. Recently, the Hong Kong government published the Mainland Judgments in Civil and Commercial Matters Reciprocal Enforcement Ordinance and rules confirming their implementation from January 29, 2024. This means that Hong Kong courts, based on mainland court judgments, can directly freeze assets in Hong Kong without a retrial for those involved in civil or commercial disputes. Previously, Chinese courts could only freeze assets in the mainland but not in Hong Kong. This judicial reciprocity currently applies to only civil and commercial disputes, not criminal offenses. As a result, many are transferring their Hong Kong assets wholly or partially to Singapore, Europe, and the United States. Particularly, Singapore is set to gain from Hong Kong's losses. Due to the Chinese government's failure to achieve free convertibility of the yuan, but eager to create a false narrative of yuan internationalization replacing the dollar, Hong Kong is becoming the only channel for substantial yuan to dollar conversion. Combined with Hong Kong's consecutive fiscal deficits, many are concerned that the Hong Kong dollar-US dollar peg could soon collapse. Li Shimin, an economic commentator now based in the US, believes that after the implementation of the Hong Kong national security law, that
the pegged exchange rate will survive on the surface, as Beijing may gradually make the yuan the de facto circulating currency in Hong Kong, with many large-scale infrastructure projects and transactions being forced to settle in yuan. However, more technical restrictions will likely emerge when withdrawing US dollars in Hong Kong. At that point, the pegged exchange rate need not be formally abolished, but the historic value of the Hong Kong dollar will have ended, and Hong Kong's economy will no longer have a safety valve, merging with all economic risks of mainland China, marking the end of Hong Kong's free economy as we know it.